we classically think of cash as the safe investment and things like stocks or other sort of investments as the risk you're taking on risk by doing those activities. The problem is that every few decades that briefly gets turned on its head, where cash ends up being, as risky or more risky than some of those other assets.
This is Dunnigan Kaiser, founder of Liberty and Finance. I'm now a licensed gold and silver dealer with Miles Franklin. Call me directly for the physical gold and silver that you need at the best price with personalized, private service from one of the oldest and best respected companies in the business. 30 years strong, A+ rated by the Better Business Bureau, 0 complaints, licensed and bonded, insured delivery or vault storage or IRAs, excellent prices, privacy and confidentiality, pay by check, money order, ACH or wire, satisfaction guaranteed. Call me directly at 419-819-9209 or my associate at 310-562-6400 or email us at kaiser@milesfranklin.com.
Welcome back to Liberty and Finance. We have a returning guest. Lyn Alden, the founder of Lyn Alden Investment Strategies, is joining us again this Monday, May 3rd, 2021. Lyn, thanks for coming back on Liberty and Finance.
Happy to be here. Tons to talk about.
Every time we've had you on, our viewers are uniformly astonished with your lack of ambivalence. You're so clear with your answers. They're so detailed. You've been able to speak very fluidly about many different topics. They're very impressed with your level of analysis and very grateful for your presence here on our channel, as are we. And we'd like to kick it off today talking about inflation as a major topic. There's been quite a bit of controversy. I would say that we've had very divergent opinions of people we've identified from different camps about is there even any inflation going on or not. We've got Jim Rickards and the Fed and some others on one side saying the way that the Fed is measuring it, there's little to no inflation because there's not enough velocity of money. You've got John Williams from shadowstats.com, you've got the Chapwood Index and others on the other end of the spectrum saying we've been having 6 to 10% inflation for the past decade. The truth is critically important to ordinary people and to our subscribers because it affects so many aspects of our lives about the real performance of investments, of their retirement, of their earnings, of their savings, and also, as Rick Rule keeps reminding us, about the anticipated time to stay in or leave precious metals as a hedge against inflation based on what the real interest rate is. So could you push away some of the clouds for us and demystify this and tell us what your latest research is showing you about the truth around the current state and recent history of inflation and where you see that heading next?
Yeah, happy to. And so, first of all, it helps to define terms. And so often people get hung up on the terms. And so, inflation in the really strict sense is an increase in the broad money supply, especially on a per capita basis and compared to the amount of products and services in the economy. Now, that generally leads to broad price increases for goods and services, and that's what we think of as consumer price inflation. We can also have asset price inflation as well, which are generally not included in those consumer buckets. And so if you look at the ultra long term, like literally going back 150 years, broad money supply per capita and inflation, price inflation for broad goods tend to be pretty correlated, where when you have big increases in how much money there is per capita, broad money, not base money, but broad money, that includes currency in circulation, checking accounts, and savings accounts, that generally pushes up the price level of goods and services. And then, similarly, if you have periods of slow money supply growth or in rare cases, decreases in the money supply, that tends to put downward pressure on prices. Velocity has a much more, a less correlation longer term. So generally, if you look back over 150 years, you've had steadily declining velocity with temporary periods of going up. And so, for example, you had very high velocity in the late 1800s, but inflation was very low due to massive productivity gains, things like that. Then you had, tons of inflation during the 1940s, but velocity didn't really change much compared to the prior decade. You also had high inflation in the 70s, but velocity was not really any higher than it was in the 50s or 60s. In the 90s, you had an uptick in velocity, but you did not really have an uptick in inflation. And so that correlation is somewhat weak, with the exception that if you have a deflationary shock, generally velocity goes down very briefly, and that tends to temporarily offset inflation. But if you stretch it out over the longer term, velocity is not one of, in my opinion, the best indicators. And so going back to that inflation versus broad money supply growth, that tends to be the correlation to look at. And if you look at, multiple countries, 150 years of data, great correlation. But there are periods of time where you can have a decoupling, where money supply grows more than inflation by a bigger amount than normal. And those tend to be periods of rapid productivity growth that basically, for example.
Sorry, I cracked up because I was just thinking about the huge increase in the currency supply in the last 9 months here, trillions and trillions and trillions, and the productivity just, okay, go ahead.
Yeah, so if you look at, for example, in the late 1800s, that was an era of, the money supply grew very quickly, but prices were low. We had, the creation of the Transcontinental Railroad. We had the invention of, light bulbs, electricity, internal combustion engines, oil pipelines, all sorts of basically huge gains in productivity. And that helped keep, the prices of commodities and things like that pretty low, despite the fact that we had a pretty strong money supply growth. There was another period, for example, in Japan after World War II, they entered another one of those kind of economic miracle periods where you had a big increase in broad money, but because they were so productive, goods and services grew just as quickly, and so that really kept CPI low. Now, the 90s and all the way to present have been a more challenging period because in some ways we've had that where due to automation, due to offshoring, there have been productivity gains that put down wage prices and basically certain types of goods deflated in price. But on the other hand, that's been not even across categories. And so you've had education going up far quicker than official CPI. You've had healthcare going up far quicker than official CPI. You've had the median house price in the United States going up much faster than CPI. You've had, if you look at the Big Mac index, so The Economist tracks the Big Mac prices every year, and they do that for multiple countries. And actually, the reason they do that is because it's a fairly standardized item. It involves multiple commodities. It involves domestic labor. It involves energy, and McDonald's has to support their real estate, costs as well. And so it's actually kind of a very broad item that doesn't change very much. And so that's risen faster than CPI. That's risen faster than the food portion of CPI. And so basically, we've been in this environment where a lot of the essential expenses that people have generally, trended above CPI, whereas a smaller collection of things such as electronics and offshored goods have put somewhat downward pressure on kind of more discretionary areas. And so you've had this, kind of mismatch between what official models are saying versus what a lot of people are experiencing in the real world. And to compound on that, they've changed the way that the quality adjustments work. And a really good example of that is with cars. And so, for example, if you look at the price of a Toyota Camry in 1990 compared to 2020, it almost exactly doubled in price. If you look at, say, the automatic basic Camry versus the automatic basic Camry today, doubled in price. So 100% price increase. The official new car CPI says the new cars went up about 22% during that 30-year period. And so their way of calculating it is to say, okay, well, cars got so much better that even though they went up, they doubled pretty much on a per model basis, that if you factor out the fact that, they all have power everything now, you have a navigation system, you have better gas mileage, better safety features. So they go ahead and offset that. And so it's one of those things where I think a certain amount of offsetting is useful. I mean, it is true that they've gotten better, we put more into them, but I find it hard to bridge that gap between a 100% increase and a 22% increase. And if you then go back and say, okay, what is the median number of, like, if you how many weeks does the median male income have to work in order to buy that car? It's about the same, give or take a week. And so, basically that's been one of the ways where the model says, okay, we've offset some inflation, but in reality, people are not feeling that because technology's made the car better, but not cheaper. And so we've had this kind of unprecedented period of quality adjustments, technological deflation, offshoring that have been, kind of counterintuitive, whereas a lot of the essential goods and real estate and asset prices have generally been inflating closer to what we expect from the broad money supply going up as quickly as it has been. So what does that impact for people? Can you talk to us about, bring that, let's start out big picture and then bring it home. How does that change people's lives
at a sovereign debt level based on the CPI, things that the whole program that the federal government is doing in various major programs, how that's affected by the CPI, versus if you take it down to the household level, how it affects people, earners, savers, retirees, that kind of thing.
So at the household level, the issue that people are running into is that major expenses are generally growing more quickly than wages, because wages have been suppressed by a lot of that automation and offshoring activities, whereas those essential things like healthcare, education for many types of jobs, median house prices, those are things, food as an example. And so that's all been going up pretty quickly. And so that's hard for that the same kind of family unit to be able to afford that. At the same time, in order to achieve that median income, more education is needed than it used to be. And so basically, someone in the 70s, 80s, 90s could get a median job and earn that median income, without a college degree. And college degrees were kind of more for higher income, whereas now you generally need that in many cases to get that median income, which comes with student debt and kind of eats into some of the costs.
Well, yeah, I mean, that seems like a perfect example of the balancing. If you're going to derate vehicles on the same model of vehicle, the Toyota Camry can't be comparable now because it's better. But here you say to earn median income, now you need to invest more and take on debt and that kind of thing.
Exactly. And that's one of the things where people have felt that very, very acutely, especially because out of almost all categories, tuition's been one of the fastest increase. It's even faster than healthcare. And it's increasingly important for not only people themselves, but also, their kids. And that, of course, people can bypass that with certain types of trades. They can bypass that with certain types of entrepreneurship. So it's not like you need an education, but for many types of jobs, it's still highly correlated with a higher income. And so that's a challenge for a lot of people, especially because a lot of the types of degrees or types of jobs that don't need a degree, they're the ones that have been most pressured by automation and offshoring, and therefore they're generally ones that pay lower than they used to on a inflation-adjusted basis. At a national level, basically the Federal Reserve's been in this period where they're specifically targeting 2% inflation the way they measure it, and so the challenge there is that if you are invested in, say, bonds or cash that are yielding 0, and the Fed's looking for 2%, and then when you say you factor out some of these quality adjustments, and people can measure their own inflation basket if they like to, because for example, my inflation, my what I buy is probably not identical mix to what you buy. It depends on how big a household is, depends on where they live, things like that. So people have their own kind of inflation baskets, but for most people, that 0% yielding interest rate is not keeping up with their actual cost of living, and so you have basically a period of currency devaluation. And if you look back in history, every few decades you generally have periods of time where cash and treasuries fail to keep up with inflation, and that's basically these cyclical currency devaluations we go through. And so it's important to kind of be aware of that when positioning for it.
Okay, and on that same regards, can you talk about retirees, people that are either nearing or in their retirement years, how that's affecting them, whether that's through savings accounts, pension plans, Social Security?
Well, it makes it hard for pensions to reach their targets because, for example, pensions generally have like roughly a 7 or 8% total, annual return target. And that historically has been a pretty safe portfolio because they put a bunch in bonds, they put some in stocks. And when bonds were yielding, say, 5%, and stocks they were hoping to get 10 to 12%, they could balance that out and get 7%. But when bonds are yielding, 1.5%, if that, they have longer duration bonds, and then they pour into equities that are at by many accounts either highest valuations on record or at least second highest valuations on record. In part because those interest rates are so low, it makes it really hard to have forward projections that are 7% returns. And so it's challenging for those pensions to, over the long run, meet out their liabilities based on current financial conditions. And then when you go back to, say, cost of living adjustments or any sort of fixed income thing, those are based on these inflation baskets that are modeled out. And so any inaccuracies in those models, either on purpose or just calculation methods, means that those people are their income might not be keeping up with their purchasing power, their cost of living. And so basically, unless their income and portfolio is much larger, unless they have a really big margin of safety, that can cause them problems in being able to afford the things that they need.
You mentioned in passing earlier real estate. We have a specific question on that from a viewer, Mars, who says, what does Lyn think of the real estate market valuation? Can she talk about real estate versus gold and silver ratio?
Yeah, so if you look at, the long run, if you look at, say, Robert Shiller's data, he's the professor from Yale he's known for the cyclically adjusted price to earnings ratio, CAPE ratio of the stock market, but he also has a long-term series going back to the late 1800s on the real estate market. And in general, this is one of the hottest that it's ever been, comparable in many ways to the 2005-2006 period. But with the good difference between now and then is that you have less bubblicious stuff in the subprime space. So there's generally more money down in this period than there was back then. But other than that difference, so you don't have like the banking system as over leveraged and attached to real estate like it was back then. But you still have asset prices, real estate prices that they've gone up so quickly, and that compared to other types of metrics, they're rather expensive. But of course, real estate being a local market is very zip code dependent. And so, for example, real estate in some of those booming markets is generally going up at a very fast rate, whereas real estate in some of the less attractive markets hasn't moved nearly as much. And so, this is a period where we've had this big influx of, people moving from cities to suburbs, or at least, the percentage that have wanted to. So that has caused a bit of a demand shock. Then you have situations where lumber prices are soaring because there's been that interest in building homes and remodeling homes. And so even though timber prices are still low, lumber prices are high because there's only so much capacity to turn timber into lumber and basically to treat that and make it usable. And so we're in this period where it's very hot right now. And longer run, I do think that, for example, many houses that are not in very bubblish areas that have, say, a fixed mortgage attached to them could do pretty well in terms of sustaining their kind of value over the long run. But I'd be very cautious about properties in some of those bubblicious areas. I mean, if you look at some California real estate, for example, there's like almost things that look like a shack, and they're like $800,000 or $1 million. And those are the types of markets that I'd be concerned about. And then it's also, if you look at other markets like Canada and Australia, they never really had that big real estate correction that the United States had, a decade ago. And so many of them are just, they've never had that pullback. And so they're extremely highly priced as well. So that's one of the areas that would concern me, around the world.
It's interesting you mentioned California, because there's been this phenomenon of urban flight throughout the COVID area, where people are waking up and finding out that the hand has been revealed of their local government, their state government or whatever, as far as how restrictive or honoring of people's constitutional rights and liberties and freedom they are going to have or not have. And so there's been this huge exodus from California to places like Arizona, Colorado, Idaho, that sort of thing, and then out of New York down to Florida and other places. So you've got people moving into freedom-loving states and moving out of sort of collectivist-loving states. But a lot of that data is being questioned now, or being revised. And it's interesting because we keep hearing anecdotal stories of these flocks of people leaving these restrictive states or urban areas, and yet now we understand that there's some controversy on the official what's the true numbers, because it will impact not only real estate, but it will also impact representation in the federal government and so on. It's going to be a really interesting unfolding story there, but it's just distressing when we can't get a straight. We talked about not straight facts on inflation levels, the consumer price index. Now we can't get straight facts on actual relocations. There's a question related here from Momo Chacha, who says, could Lyn let us know her thinkings about an inflation and deflation? Notably, does she think the Fed will be able to control the interest rates if inflation is so important?
They have the ability to control interest rates, but then they have a release valve, because there's no free lunch. And so basically, let's say inflation runs hot and bond yields try to push up. They can suppress the interest rates like they did in the 1940s, but then the release valve for that ends up being the value of the currency. Because if those treasuries are yielding a much lower interest rate than the inflation rate, then basically the value of those bonds and cash gets devalued significantly. And so, for example, in the 40s, if you look back, say, there's been 2 inflationary periods in the last century. And if you go back further than that, there was a 3rd inflationary period during World War I. But if we just focus on the more recent 2, one of them was in the 40s. You had, in many ways, a similar environment today where money supply went up. Basically, money supply can go up from 2 main reasons. One is bank lending. So banks, create more deposits when they loan money. And so the types of money supply increases you saw, for example, in the late 1800s or like the 1950s and 60s, a lot of that was from bank lending. Whereas you have other periods of time like the 1940s or 2020, where the money, the growth in the money supply mainly comes from the government running these large fiscal deficits and having a lot of that monetized. And so if you look back in the 40s, it was actually a very similar monetary, environment than we have today, with external catalysts, of course, being the war in that period. And so in that environment, basically you had inflation run hot, but they still held interest rates very low. They basically did yield curve control. They purposely suppressed the interest rate. And the purpose of that was because, federal debt as a percentage of GDP got over 100%. And so rather than let the interest rates go up very large and that would basically render things insolvent, they basically chose to devalue the currency, kept interest rates at near zero, and basically just, if you were holding treasuries, you lost over a third of your purchasing power during the course of a decade. On the other hand, the next inflationary period, three decades later in the 1970s, by then, through a combination of inflation and, some degree of deleveraging, they had, debt as a percentage of GDP was very low by the time you got to the 70s, both on the federal side and the private side. Basically, the debt to GDP ratios were much lower than they were compared to prior decades. And so when inflation started to run pretty hot, they were able to raise interest rates significantly to quell that inflation, because the low debt in society allowed that, those high rates to be able to go up without causing everything to be insolvent. And so if we look back where we are today, our situation looks more like the 40s, where even if inflation runs hot, they can't really raise interest rates because it would render so many things insolvent. And so you're more likely to get that scenario where inflation goes above interest rates for a long period of time, currency gets devalued, and then that, then we see how far that goes, and then we kind of look towards the next cycle. And so that's kind of how I see this playing out, where they can control interest rates, but they can't control simultaneously interest rates and the value of the currency.
We've had several on speaking about that. Alistair McLeod, former bank president and analyst, talking about that dilemma that the Fed finds themselves faced with, but that there's real room there for ordinary people to get hurt by that. Can you talk to us about the exposure that ordinary savers have in that environment and some options that they have for how to protect themselves? Because it sounds like a freight train heading towards ordinary people on the tracks, and we got to get them off the tracks.
Well, that's the challenge. If you have, say, we classically think of cash as the safe investment, and things like stocks or other sort of investments as the risk. You're taking on risk by doing those activities. The problem is that every few decades that briefly gets turned on its head, where cash ends up being as risky or more risky than some of those other assets. And so, for example, if you look at World War I was an interesting period, because that was one of those periods, but it had a very specific cause. Whereas the 1940s and the 70s were the next two examples, where if you held cash in the bank, during the course of that decade, you lost, depending on exactly what types of instruments you were holding in, you lost 30 to 40% of your purchasing power by holding many of those types of assets. And so, you got everything back nominally. And you say, okay, you had 10,000 in the bank, you got some interest rate, and you ended the period with 12,000 if it was the 40s. You ended the period maybe with like 20,000 if it was the 70s. But whatever that number was, it did not keep up with the cost of buying a broad set of goods and services. And so, the way to hedge against that is to be more diversified with your asset mix and to favor real assets. And so if you're in an environment with positive real yields and strong productivity gains, then things like commodities, for example, generally don't do well in that environment. Whereas if you're in a period where real interest rates are negative and you're more likely to get that inflationary outcome, then having investments in commodity producers or commodities themselves is a good hedge, generally speaking. And so you can also look at different equity markets around the world have different relative valuations. Historically, whatever equity market does very well in one decade is not necessarily the same. It's usually not the same equity market that does very well in the next decade, because you go through those kind of shifting valuations and shifting policies. And so, for example, there are many equities around the world that are still trading at reasonable prices, but they haven't had this really big feedback loop of us running big. The United States runs very large trade deficits. Foreign sectors, with those surpluses, take that money and they pour it back into like the S&P 500. And so we've kind of had this, this virtuous cycle of propping up our asset, our stock market. But if you were to run into a more inflationary scenario, there are other markets that I would find to be, more attractive. And so I think it's one of those situations where people have to be more diversified than just you thinking they're safe by being, 100% in cash.
Right, where cash, I remember Robert Kiyosaki saying cash is trash, but within a limit. I mean, it's not as a source of savings, but Rick Rule talks to us about having some cash liquidity because so you can take advantage of some of these upsets that come. We're really concerned about people who grew up with the normal bias of thinking that cash savings in the bank is the way to hedge yourself against what's coming. We have a related question from Zenity, who says, when the, quote, system becomes chaotic enough for even the normies to recognize that something is wrong, will there be a fundamental change in fiat?
It's interesting because if you look at, for example, the 70s, when that period ended, they still then entered it didn't really permanently change a lot of behavior. And I mean, so as it relates to, people viewing money as a form of savings. And so, now, in that period, precious metals became very popular. We had a similar period, after the global financial crisis where precious metals became very popular. Lately, we've been in a period where digital assets have been pretty popular. So the narrative of alternative ways of holding things outside of, a fiat-based system have kind of caught on. One of the differences now is that we have social media, and so ideas spread more quickly. And so there's like the money printer go burr meme that spreads around on social media where they show people just printing money, and so that types of thing spreads around more quickly than it did in the 70s or the 40s and things like that. And so that can cause reactions quicker than you think. And so we have entered this environment where at the current time, the mainstream is now talking about inflation, but the narrative is that it's transitory, that that it's going to go up, we're going to have base effects, and then it's going to go back down, and that's kind of the main narrative. If that becomes stickier than that mainstream thinks, then I think you could definitely kind of shift back and start viewing these other types of investments. That it's one of those things where, again, what happens in the last decade is generally not what happens the next decade. So we have this broad idea that commodities are big underperformers. They've done really bad over the past decade compared to, say, highly valued tech stocks. But if you were to get an inflation breakout that proves to be pretty persistent, and basically even the official metrics are it's basically showing that inflation's happening, that's when you could have that bigger rotation back into some of those things that have been kind of left for dead for a long period of time. And we've seen that play out in recent months where some of those commodities are really spiking and people are talking about it. But it's still within the context where they view it as transitory. And one of the distinctions I make is that there's a difference between transitory in rate of change terms and transitory in absolute terms. And so, for example, if you look at the 40s, you had three big inflation spikes. And so it was transitory inflation, meaning that you had a big spike in inflation and then it came back down. But there were no corresponding periods of deflation where the prices went all the way back down. So each spike was a transitory spike, and then it settled down to a new plateau, and then it would do it again. And so basically that's the difference between transitory, like an actual transitory, meaning the prices go up, they have a brief supply shock, and then they come back down. Whereas if those prices are in part driven by an increase in the amount of broad money in the system, those prices generally don't go back down to their starting point. So you might have some areas like, lumber is crazy right now. That's almost certainly going to come back down. Whereas, for example, when you have Coca-Cola and Procter & Gamble raising prices on some of their goods and passing that along, those are likely to be sticky and kind of new levels to where they price going forward. And so I think when people realize that more, that starts causing changes of behavior.
Right, and you mentioned when the mass of people wake up to the fact that prices are are more persistently increased than they've been told. What about people who want to be plugged in, want to be aware and prepared ahead of the masses? What is your view of where prices and where the value, the real purchasing power of the currency is going in the next, say, 1 to 3 years?
I mean, I think most fiat currencies are going to see that their purchasing power is going to go down over the next 3 years, and so that'll obviously depend on different rates. If you're in certain types of emerging markets, you might lose a ton of value. If you're in developed markets, you might lose a moderate amount of value during that say a 3-year cycle, and mainly it's because just whatever inflation ends up being, anywhere between 2 and 7%, let's say, that if you're earning 0 or 1% on that money. You're just getting, it's a melting ice cube, and it could be a quick one or a slow one depending on exactly where you live, but it's still a melting ice cube. Whereas, say, diversifying into things that are more finite is helpful. Now, the one area that currency might even strengthen against is the stock market. If you were to have, say, an inflationary event happen and then central banks try to cool back on some of that policy, then you could have the stock market roll over and start causing issues there. And so I think there's going to be a difference between we've had this period of 10 years now where, we've been in this period of commodity oversupply. So every 15 to 25 years, we have these big, commodity capex cycles. And so, one of the things that has kind of suppressed inflation to some extent over the past decade is that we've been in this period of commodity abundance. And so so many commodities, for example, are at a lower price than they were 10 or 15 years ago, with some exceptions. So lumber, beef, they went vertical. Gold touched new all-time highs in 2020. But if you look at, energy's been very low price. Copper, despite doing very well, still not at all-time highs. Many agricultural products are, they're on fire lately, but they're still not at all-time highs. And so we've been in this kind of, until this past year, we've been in this kind of commodity bear market. Now we're starting to wake up, but we're still not, soaring yet. And so that's kind of put pressure on things. But as we go forward, if we go into the 2020s, there's an increasingly good chance that the commodity complex as a whole starts going back up, and kind of that even some of these prices like lumber will ease, but that the broad commodity index is likely more in an uptrend now. And so that's one of those things where you want to have exposure to things like that rather than being, say, purely in cash. And I agree with what you said before and what Rick Rule said, where I hold cash, for example, as part of my asset mix. It's important for managing liquidity, especially if you have expenses over a certain period of time. If you want to be able to buy opportunities, that if there's any kind of brief sell-offs or brief deflationary shocks or reductions in certain types of asset prices, it's very useful. But the main risk comes from people who are just they're like all in on cash and bonds, and they're not realizing that they want to have at the very least some hedges against those positions.
Right. Protection or insurance against a big devaluation of your nest egg is a serious financial existential problem for people who have thought that was the island of safety to be in times of uncertainty. We've certainly had a lot of uncertainty in the last year. I mean, nobody would have predicted what we've been through in the last year and a half, all the changes. We have another question here from David Clark, who says, Lyn is my favorite commentator because of the wonderful talent for making economic jargon understandable. Please ask why understanding international capital flows could be important to the individual investor.
Yeah, so if you look at, we touched on this earlier in the talk, where we've been in this cycle where the United States has built for itself structural trade deficits. So we import a lot more than we export, and therefore we export a ton of dollars to the rest of the world. And those dollars, those companies get those dollars, and then they do foreign exchange, and then so those dollars accumulate in basically investor accounts and in central bank level. They kind of go up the chain there. And so you have, in some cases, those central banks take those dollars and they go back and buy U.S. assets with them. And then you have other large pension areas like that they go and they buy U.S. assets. And so you have capital flows as it cycles around the economy can concentrate in certain markets and make them overvalued. And so in the 1980s, for example, a lot of capital flowed into Japan, and that's part of what along with many other factors caused that absolutely massive bubble that they had. And if you look at the current period, there's not been a lot of capital inflows to emerging markets. We've been in that kind of bearish cycle for that type of activity. On the other hand, we've had just recycling these really big trade deficits back into U.S. markets. And so you have like the Swiss National Bank like buying Apple stock, for example, just basically just putting money back into U.S. markets. And so the risk there is that if you do that enough and you kind of get that big, just massive secular blow off top, that market becomes very, very expensive, and then is prone to having a long period of poor forward returns, just because it's starting from such a high level. And then capital flows could then become a vicious cycle where they say, okay, that market's doing poorly, let me pull money out and go to emerging markets. And so that kind of feeds on itself, and that's why these cycles tend to be longer lasting and larger than you might expect. But when they do turn, it can be pretty significant.
I'm going to circle back to one thing you touched on earlier when you said you do hold some cash because it gives you opportunities to take action as certain opportunities present themselves, like a market downturn. Alex Stuhlin says, can you ask Lyn, would it be a good thing to just stay out of the market now because everyone thinks the market will collapse? Well, it depends who you talk to, because some people think it's going to go up forever, and some people think we're on the verge, have been thinking for years it's on the verge of a collapse. But what's your thought about a strategy for people who are concerned about making sure that they aren't boxing themselves into a corner? Is there a place for keeping some cash on the sidelines right now, or other forms of liquidity? Rick Rule also talks about bullion liquidity, but what's your thoughts on staying out of the market or keeping a foot in the market?
So I kind of two answers to that question. One is, yes, I do have a segment that is in, cash or T-bills, in my broader asset mix. So I do think there's a way to manage that liquidity to basically act as like a shock absorber for any sort of sell-offs that happen in some of those other assets. The other point I would make is that there's not just one market. There's not just, say, the S&P 500. There's markets around the world. And like I've been saying, I mean, I've been finding cheap equities in different markets, for example, where they, many of them, the company's still doing fine, but due to low valuations or due to some of these dollar cycles that we're witnessing, they've been, their stock price might have been in a 5 to 10 year consolidation where they're not showing any signs of being a bubble, whereas other assets are. And so, rather than just kind of being like a light switch, like on or off, I say, okay, let me define like 10 different markets where we have like, say 5 different country equity markets, and then we look at the precious metals market, we look at industrial commodities market, we look at the bond market, we look at the real estate market. We have kind of these different buckets, and so rather than saying I'm in or I'm out, it's more like out of these buckets, where do I want to have significant amounts of capital? And so that's kind of the way I'm looking at it, where there are many types of equities where they're below their 5-year average. I'm fine with being in some of those if I think they're high quality companies. There's also some stock prices that have done very well, but their fundamentals have done well also, and so I still think they're reasonably priced. But then at the same time, we are starting to see a lot of excesses, especially in U.S. markets, where if you look at the rate of change of margin debt, that's gone up very quickly. So that's looking kind of early signs of being toppy in a sense. You also see it's that a lot of that liquidity spilled over into crypto markets, where there are some of them like Bitcoin that I like the fundamentals for, but then if you go down the spectrum there into the other cryptocurrency, you have things like Dogecoin that was originally created as a joke, but then it's a multi-tens of billions of dollars market capitalization now because Elon Musk has been promoting that coin, and so it's literally a joke coin that's worth more than like Credit Suisse, and so you have situations like that where you have these kind of pockets of bubbles that when you start to get a liquidity event can come down pretty quickly if you're not careful.
As far as what might keep the equity markets rising versus when they might roll over, some people have talked to the Feds coming out and saying, oh, we've got all kinds of tools in our toolbox. We have unlimited funds that we can do this with. There are lots of tools we haven't used yet. Dr. Dog Will Hunt asks, aside from yield curve control, what other, quote, tools does the Fed realistically have?
They can change their rate of asset purchases. And so, for example, when inflation starts to run hot, they can say, okay, we're currently buying 120 billion of treasuries and mortgage-backed securities a month, and they can start dialing that number down. And it's one of those things where they can kind of fix one problem, but then they start because they've kind of boxed themselves in, they start causing another issue. And so we saw, for example, when the Fed tried to start quantitative tightening and raising rates towards the end of the previous cycle, we started to see a lot of the market started going sideways. We saw certain credit events, and then they were forced to then pivot out of that and kind of, go back to cutting rates and pumping up the balance sheet. And so I think we could see a similar event now where, they say, okay, inflation's running hot. We're going to, that we now consider the market to be functioning pretty strongly. We're going to start dialing back our asset purchases. We're going to start, pulling that back. We're actually already seeing certain central banks like Russia raise their interest rate. Canada, is looking at asset purchase rate reductions. And so as we go later into this year, I think you could see some of that pullback among how much support they've been giving markets. And so some of these assets that don't have good fundamentals underlying their current prices could start to see more headwinds. Another factor to look at is base effects. So if you look at year-over-year comparisons, this quarter two that we're in has very favorable comparisons to the quarter two of last year, because that was the worst part of the pandemic. That was literally, oil went negative, we were all like shut down. And so the GDP comparison, the corporate earnings comparisons, the year-over-year economic comparisons, the year-over-year inflation comparisons, all of those are very high. Whereas once you start looking at quarter three, quarter four, the base effects are not as easy, because by that point, the economy was already kind of bouncing back with the stimulus and things like that. And so when you do that year-over-year comparison, it's less attractive. And so when you're kind of getting those harder base effects combined with central banks that are maybe starting to tighten around the margins, that's when I think some of these kind of localized asset bubbles are at risk.
We have many more questions than we have time to ask them, so we'll just ask this one more. Callisto says, do you see gold or silver rising with the dollar strengthening in the next year, and what do you see happening with them with rising bond rates?
So that there are periods of time where gold and the dollar rise together. That's not a super strong correlation. The strongest correlation that gold has is with real interest rates. So a lot of, especially the paper market of gold, right? So if you see certain market events like March, you can have the physical gold market and the paper gold market behave very differently. But if we're talking about spot price of gold, things like that, that tends to follow the 10-year Treasury rate minus you can either use CPI or you can use the TIPS market break-even inflation rate for kind of a daily update version rather than one with a lag. And so gold tends to inversely follow that very closely. And the reason for that is, if you have, say inflation is running at 3%, but you can get treasuries that are yielding 5%, well, that's a 2% positive real yield. And so that's a fairly attractive asset to hold, whereas gold is a yieldless asset and might not do very well in that environment. But suddenly, if inflation's 3%, but treasuries are yielding 1%, well, now your real interest rate is negative 2%. And suddenly that yieldless scarce gold is a lot more attractive looking. And so, we've been in this period where 10-year rates bottomed in August 2020, and they've been rising. And that's been putting some pressure on gold because those rates have risen about equal to or a little bit faster than official CPI has been rising. However, as we look forward with some of these base effects kicking in, basically 10-year treasuries could still go up a little bit more, but real interest rates could go down because inflation now is kind of, especially with these base effects, inflation is now more in full swing as we look out in, say, late spring and early summer. And so we've been seeing some kind of reasonable signs of gold and gold miners kind of, finding some more support here after a multi-month correction and kind of pushing back up. And whether that'll continue or not, I think is an open question. But I'm more constructive here than I was, say, a couple months ago, because the trends have been changing back in their favor generally. As for the dollar compared to other currencies, if you look at some metrics, the dollar is likely to increase compared to them because say you compare U.S. growth differential compared to European growth or Japanese growth, that is currently higher than normal, and that tends to be dollar positive. On the other hand, if you look at U.S. Twin deficits, that also tends to be correlated with the dollar, and those have been, those are falling off a cliff right now. And so if you look at their models, the dollar should also go down a lot. I've been, ever since October 2019, I've been in more of the structural dollar bearish outlook, meaning that I think we're kind of playing out a multi-year kind of a sideways to down dollar market compared to other foreign currencies. but you'll have counter rallies in there. And generally, those dollar bear or dollar sideways periods tend to be better for commodity prices, all else being equal. But overall, that's kind of how I'm seeing this playing out, where I think most currencies are going to devalue versus say these commodities and gold going forward, and that the dollars is probably going to be one of the weaker major currencies. But there are a lot of moving parts there as it relates to timing.
Well, Lyn, there's a lot more to talk about. We're going to have you back on more often. But if people want to follow your work on a continual basis, where should they get plugged in?
So I'm at lynalden.com, and I have a bunch of free articles. So I have a low-cost paid research service, and I'm active on Twitter at Lyn Alden Contact.
And folks, if you don't want to miss any of our interviews with Lyn or any of our guests, make sure you go to libertyandfinance.com. Over in the left-hand margin, put your name and email address in there. Get on our free newsletter that comes out at least 3 times a week. It has descriptions and links to all of our interviews and any links to any of the guests that they provide. Lyn, thank you for joining us again here on Liberty and Finance.
Yep, thanks for having me.
This is Donnegan Kaiser, founder of Liberty and Finance. I'm now a licensed gold and silver dealer with Miles Franklin. Call me directly for the physical gold and silver that you need at the best price with personalized, private service from one of the oldest and best respected companies in the business. 30 years strong, A+ rated by the Better Business Bureau, 0 complaints, licensed and bonded, insured delivery or vault storage or IRAs, excellent prices, privacy and confidentiality, pay by check, money order, ACH or wire, satisfaction guaranteed. Call me directly at 419-819-9209 or my associate at 310-562-6400 or email us at kaiser@milesfranklin.com.